Now let's record selected transactions for JJ Lawn Care Services. Okay, so the next slide is that on May 1st, Jill Jones and her family invested $8,000. Remember, in JJ's lawn care service and received 800 shares of the stock. So here, you can easily guess that the business is going to receive the cash, and in return, the business is going to give its ownership to JJ and her family. So, what will happen in the business? So, will cash increase or decrease due to this transaction? So, obviously, the business is going to receive a cash of 8,000. So, the cash will increase, and owner's equity will also increase by 8,000. So here you can see that cash increased by 8,000 with a debit and the capital stock increased by 8,000 with a credit. So you can see the nature of cash is asset. So because nature of cash is an asset, so when the asset is going to increase, it will post it on the debit side. Whereas when the owner's equity is going to increase, it will post on the credit side. So in this way, you can see that you can directly post the entries on the T account as well. So on May 2nd, JJ purchased a riding lawn mower for 2,500 cash. Now in that situation, if I'm going to ask you that will cash increase or decrease due to this business transaction, and what will happen to the other account, that is tools and equipment, increase or decrease. So you know that the business is going to purchase the tools and equipment and they are paying the cash. So obviously the cash is going to decrease by 2,500 and tools and equipment will increase with the amount of 2,500. So you can see that one asset is going to decrease by 2,500. On the other hand, another asset is going to increase. So if you see that cash decreases 2,500 with credit and tools and equipment increases 2,500 with a debit. So in the same T account, now we need not to repeat the cash account, or we need not to prepare an additional cash account because already we have the cash account. So now the cash is going to decrease. This is one of the asset that is decreasing, and then the asset is decreasing, we will have to post it on the credit side. On the other hand, the other asset has increased by 2,500. So if you are going to see the net effect, so one asset is increasing, other asset is decreasing by the same amount, so the overall effect on the asset side will be nullified. Okay, so in the next entry, on May 8, JJ purchased a truck worth of $15,000. JJ's paid $2,000 down in cash and issued a note payable for remaining $13,000. Now, the activity or the business transaction that is occurring is that the firm has purchased a truck that is worth $15,000, but the firm did not pay the entire $15,000 amount. The firm has paid $2,000 in cash and rest of the $13,000 in as a promissory note, as a note payable, right? So obviously the cash is going to decrease by $2,000. Reason because the cash is paid out or going out from the business. On the other hand, the truck that is one of the asset and that's worth is $15,000. This would increase in the firm. So overall net effect of the asset, that cash is going to decrease by 2,000, and on the other hand, one of the asset that is truck that is going to increase by 15,000. So there is a net effect of 13,000, that the assets are generally increased by 13,000. But if you see that the firm is issuing the notes payable, that is the liability. So the liability simultaneously increasing by 13,000. So there will be the effect on the cash account, in the trucks account, and a new account will be opened, that is notes payable. So you can see here that the truck increases 15,000 with a debit, that is your asset, and when the asset is going to increase, it will be posted on the debit side. The other one, that is the cash. So the cash is going to decrease by 2,000 only because we are not paying the entire amount of the truck and we are paying a down payment, that is 2,000 only. And rest of the 13,000 we are promising to pay in the future, and we are issuing a notes payable, and that is your long term, that is your liability. And if you are promising to pay within 3 months or 6 months or within a year, so that is classified as current liability. And if you are promising to pay after more than 1 year, so this would be a long-term liability. Then on 11th May, JJ purchased some repair parts for $300 on account. So now another asset account is going to be created, that is tools and equipment. So that is 300. So we had an account that is named as equipment, tools and equipment, and we had purchased the equipment worth of 2,500. And now we are purchasing some tools additionally with the amount of $300. But we are not paying the cash, we are buying this tool or purchasing these tools on account, I mean on credit. So that means our tools and equipment, like our asset account, is going to increase by 300, but on the other hand, the account payable is going to increase. That is one of your liabilities. So assets are increasing, and on the other hand, the liabilities are increasing. So you can see that tools and equipment that were 2,500, now it increased to 2,800 after the addition of 300 more, whereas the account payable is going to increase by 300, and you know the rules of debit and credit. That is, if the liabilities are going to increase, it will be posted on the credit side. Then in the next slide, on May 18th, JJ sold half of the repair parts to ABC Loans for 150, a price equals to JJ's cost. ABC Loan agrees to pay JJ's within 30 days. So here, what is going to happen? You know that you had some, JJ has some Access repair parts. They decided to sell them. So the Access spare parts have been sold at the amount of 150. And these 150, these tools and equipment have been purchased by ABC Loan and with a promise to pay within 30 days. So though your one asset is declining, that your tools and equipments are decreasing by 150, but on the other hand, your the cash is not increasing because you are not selling those tools and equipment on cash. On the other hand, the ABC people are going to promise you that they will pay you within 30 days. So this will become your account receivable. So tools and equipment increase or decrease, so it will decrease. On the other hand, your account receivable increase. So the entry will be that tools and equipment will increase, decrease by 150, and the account receivable will increase by 150, and the effect will be nullified. Now in the next entry, you can see that this is a journal entry, and you know, as we discussed earlier, that the journal in an actual accounting system, transactions are initially recorded in the journal. So remember the first entry when you had planned to start up a new business, so that was the cash is going to be debited in the business and the capital stock is going to be credited. Okay, so this was a simple journal entry. And when you are going to bring the journal entry into the ledger accounts, it's a simple procedure. Like posting involves copying information from the journal to the ledger accounts. It's a very simple thing, that if you have the journal entries in sequence, so you can pick all those entries which are chronologically. The journal is a chronological day-by-day record of the business transaction at a convenient intervals. The debit and credit amounts recorded in the journals are transferred or posted to the accounts in the ledger. And the updated ledger account in turn serves as the basis of preparing the company's financial statements. So here you can see that we had the cash, and cash is on debit side. So you will post in the journal ledger on the debit side the cash amount. And this is a running balance situation. That is, your balance is 8,000 after this transaction. Similarly, in the next slide, when the capital stock is going to be credited, so now you can record that on 1st May, the title of the account is capital stock and it is credited, and the balance of capital stock is 8,000 after this transaction. And then the tools and equipment that is bought on 2nd of May, 2,500, and cash is going to be credited. So let's see what the cash account looks like after posting the cash portion of this transaction. Okay. So now you can see that on 1st of May, the business had received a cash of 8,000. So your balance was 8,000. Then on 2nd of May, the business purchased some equipment, I mean the earth mover, worth of 2,500 and paid cash 2,500. So periodically or perpetually, if you are balancing them off, so at that moment your cash balance was 8,000, and then after 2nd May your cash balance reduced to 5,500. So this ledger format is referred to as running balance, but as opposed to the simple T account where we will not balance off periodically or perpetually after each and every transaction. We will balance off at the end of that fiscal period. So what is net income? So now, as previously noted, net income is an increase in owner's equity resulting from the profitable operation of the business. Net income does not consist of any cash or any other specific assets. Rather, net income is a computation of the overall effect of many business transactions on owner's equity. The effects of net income on the basic accounting equation are illustrated here. So you can see that net income is not an asset, it's an increase in owner's equity. So when the asset is going to increase, the net effect of the asset is going to increase, and which leads to increase in the owner's equity, or the net effect of the liability is going to decrease and which increases the owner's equity. So you could say that either or both of these effects occur as net income is earned. But this is what net income really means. Now in the next slide, this is the most important thing we need to discuss, that is the retained earnings. Usually people consider that the retained earning is undistributed profit. Yes, to some extent that is true, that retained earning is unappropriated or undistributed profit of the firm. But this is very important, that whatever the balance in the retained earning account, it represents the total net income of the corporation over the entire lifetime of the business, after subtracting the amount of dividends which are paid out to its stockholders. I mean that whatever the net income, after subtracting all the expenses from the revenue, whatever the net income the firm earns, this will be transferred in the balance sheet. But before that, the company usually proposes its dividend policy, and whatever is being proposed dividends in its dividend policy, this will be subtracted from its net income, and the remaining amount or the retained portion of the net income is called retained earning. Now, so revenue and expenses, the price for goods and goods sold and services rendered during a given period of time, that generates revenue, and that increases owner's equity. On the other hand, expenses, that the cost of goods and services used up in the process of earning revenue, that decreases owner's equity. So one thing increases owner's equity, that is revenue, other thing decreases owner's equity, that is expenses, and the difference is called net income.
Thanks for watching. For new video updates, press subscribe button so you will notified.